Hey, what's up guys, Krishna here, and today I'm going to be talking to you guys about how you can potentially triple your gains in the stock market using this one simple trick called leveraged ETFs. While these potential gains I'm about to show you might look super duper impressive on paper, not everything is as it seems, so make sure you watch to the end to make sure that you understand the risks versus rewards and then can decide, is it worth it for me? But anyways, let's go ahead and get right into it. Alright, so what exactly are leveraged ETFs and how are they different than stocks and regular ETFs? And to put it simply, a leveraged ETF is an ETF that is designed to follow and track and replicate the daily, this is important, daily gains and losses of another ETF, group of stocks, or indexes, but multiplied by 2, 3, up to 5 times. Now, to actually get these multiplied gains, these leveraged ETFs leverage their money by buying derivatives such as options, future contracts, and stock swaps. As these derivatives can move up and down at a much faster rate than the underlying stocks that they're trying to follow, this can help increase the gains for the ETF, but will also greatly increase the risks that they're taking. Many, if not all, of these leveraged ETFs hold options which have a property in them that makes them lose value every single day that they are held. Now, unlike your standard run-of-the-mill ETF, which is probably only holding stock, these leveraged ETFs are holding assets that are actually devaluing every single day and could potentially hit zero if not rolled over. Now, according to the SEC, these funds must maintain set leverage ratios, meaning that for most, they actually need to rebalance their portfolios daily in order to keep that leverage ratio at the point that it needs to be. So for most leverage ETFs, this either means that they need to increase or decrease their cash positions, but for many of them in times of market turmoil, this actually might mean that they need to buy or sell options or futures contracts, which can be quite expensive. Okay, so now that we've got down what a leveraged ETF is, let's go ahead and work on a really quick example just so you guys actually figure out, what is actually happening over here. So on this side, let's pretend that we have a standard 1x ETF, and on this side, we have a triple leveraged ETF that actually follows the daily motions of this one. So on day one, this standard ETF on this side actually moves up by 1%. Obviously, this one, which is following it by 3 times, will move up 3%. If this one was, for example, to move down by 1%, this leveraged ETF that's following it by 3 times would move down by 3%. Pretty simple, right? So as you guys probably realized from that really quick example I just showed, these leverage ETFs can make you a ton of money in the short run if the market moves in the direction that you want it to. However, in the long run, these leverage ETFs actually become really dangerous, which is actually one of the reasons why the SEC took almost 3 years to read and approve them. In an official statement from the SEC, they wrote, "Investors holding shares of these funds over a long period of time may suffer large and unexpected losses or returns that otherwise substantially deviate from what they reasonably anticipated." So why exactly would the SEC say this after spending over 3 years working to approve them? And that, my friends, is because leverage ETFs suffer from something called decay, which over the course of a few days to maybe a week doesn't really matter, but as these compound over months and years can actually become really dangerous and actually take away a lot of your hard-earned money. Okay, so let's go back and use our example of the 1x ETF on this side and the leveraged ETF on the other side to kind of explain what this decay is and why exactly the SEC is warning you so much about it. Okay, so on one side we have our standard ETF, which is not leveraged, and on the other side we have our triple leveraged ETF that's actually going to be following the standard ETF but multiplying its gains up or down by around 3. So on day one, the standard ETF falls by around 1%, meaning that your $100 is now worth $99. The triple leverage ETF follows its direction by triple, meaning that instead of having $100, you now have around $97. However, on day 2, things are looking up, and the standard ETF now rises by 1%, meaning that you have $99.99. Remember, because of the way percentages work, you actually lost 1 cent overall. Now, the triple leverage ETF, also having another great day, following the regular ETF is now up to around $99.91. Even though the leveraged ETF followed the standard ETF, it somehow lost 8 cents, even though they both moved the same amount percentage-wise. This loss is called beta decay and will essentially affect the leveraged ETF every day that it's not moving in the direction that it's originally designed to. So while 8 cents doesn't really seem like much in the short run, imagine that the standard ETF continued to go up and down, up and down, up and down for the next 30 days, 60 days, 6 months, or even a year. The triple leveraged, double leveraged, or however leveraged ETF that you're holding would have to consistently follow its up and down days, meaning that the beta decay would actually consistently add up and actually form a pretty sizable loss, even though the standard ETF, while down, isn't down that much. And the longer the market stays flat or down, the worse it actually gets. Think about it like this. In an unpredictable market, stocks can move in one of 3 directions: up, down, or sideways, with, let's just say, a hypothetical 33% chance of moving in any of those directions. So because the market moves in these 3 directions, you basically have a 33% chance that you'll make money. Remember that because leverage ETFs use leverage and experience beta decay, you actually lose money 66% of the time, hypothetically, which in comparison to standard ETFs, which actually don't lose money when they trade sideways, is not very good odds. During times of high volatility where the stock market is moving up and down pretty significantly, these ETFs can take substantial losses and can get almost obliterated during market crashes. Take a look at SPXL, a triple leveraged ETF following the S&P 500. Now, during the crash last March, it fell over 78%, going from $76 all the way down to $16. The S&P in comparison fell 35%. If you had owned SPXL before the crash, you probably would not be very happy watching your $100 turn into just $22. But don't be sad, because with huge crashes come huge opportunities. So remember how I said that in an unpredictable and kind of standard market, you have around a 33% chance that the market will move in the direction that you want it to? Well, after a large market crash like the one that we had in March, it's pretty obvious that the market would either want to move up or really had a large chance of moving up. And this basically means that my original 33% chance of stocks moving up more likely turned into a 75 to 80% chance that the market would move up, simply because the market was oversold, Corona was starting to go away, and the Federal Reserve had pushed so much money into the economy that it was almost impossible in my mind that the market would not go up. Now, let me show you some of these leveraged ETFs and how crazy some of these gains were after the March lows from coronavirus. If you had bought SPXL, which is the S&P 500 triple leverage ETF that I told you guys about early on in the video, at those March lows around March 23rd-ish and held to today, you would be up a staggering 480%, which in comparison to if you had just bought the S&P 500 is only up 80%. That's an incredible almost 400% more than just the regular ETF, just because you had simply bought at the bottom when you knew that your odds of the thing going up were a lot higher than if you had just bought at the regular top. Okay, so let's go ahead and take a look at one of my favorite triple leverage ETFs of all time, TQQQ. Now, this TQQQ follows the NASDAQ, which for most of you guys that probably know this, is a ETF that follows most of the biggest tech names in the world. If you had bought TQQQ at the March lows of just last year, you would be up over 600% now, aka 6xing your money. Now, SOXL, a triple leverage ETF following a bunch of semiconductor stocks, is actually up over 1100% or 11x from its March lows of last year, meaning that if you had just put $100 into these at the March lows of last year, you would have that $100 turned into over $1,100 now. So while it's great to look back at these and really wish that you had bought them, it's really important to realize that a lot of these triple leverage ETFs might actually not have risen that much if the market had remained flat for a longer period of time or had many volatile days with the market going up and down very significantly. So now that I've explained what these leverage ETFs are, some of their risks and some of their rewards, as well as giving you guys some examples of how people have been doing these and pretty much explained beta decay, let's start talking about when you guys should be buying these and when you should definitely stay away from them. So let's go ahead and actually start off with when I think you guys should not be buying these, which is really more often than not. I think that these leverage ETFs are a pretty good tool to make a lot lot of money, but you have to know when to buy them. And whenever the market is really, really high and there's honestly a lot of uncertainty as if the market will continue to go up, eventually go down, or kind of just trade sideways, that's exactly not the time that you want to own these. Because remember guys, beta decay doesn't really care if the trade is going sideways or it's going down. It's always going to take money away from you unless the stock is moving up and you actually have a bullish ETF, meaning that around 66% of the time, if the market is trading at a flat time or volatile, you'll actually lose money simply because of the beta decay, which obviously losing money is not something that you want to do. So now that we've gone out of the way when these triple leverage ETFs should not be bought, let's kind of talk about, when they should be bought, and honestly which ones I've been buying and which ones have made me a pretty decent amount of money since last March. And to put it simply, I believe that triple leverage ETFs should only be bought when the chance that they move in the direction that you want it to has dramatically increased, such as after a market crash or a correction. For example, in the crash last March, I actually went ahead and bought a bunch of TQQQ, SPXL, and SOXL because personally I believe that the United States has such a massive ego that they would not actually allow their financial markets to collapse and actually have stocks be down for a pretty significant amount of time. This basically allowed me to take advantage of the United States putting a lot of money into the financial system and raising stock prices and ETF prices. As stock prices rose at a pretty significant level, I didn't actually need to worry about beta decay simply because I was moving up way more than I was moving down or sideways. So anyways, I really hope that you guys did enjoy this video. I tried to give a lot of explanation as to what a leverage ETF was, how you can profit from them, what are the risks from them, and when you should and should not be buying from them. And I honestly hope that you guys learned something. This was my second video on the finance channel. So if you guys have any comments like, how you guys use these triple leverage ETFs, are there ones that you like buying more than others? And honestly, if you have any type of criticism or critiques for me, just put them down below. And honestly, if you did enjoy this one, make sure you drop a like down below and subscribe to the channel. I'm going to try to make a bunch more of these with like some complicated topics, the market trends, what's happening, my favorite stocks, what I've been doing, and yada yada. But anyways, hope you guys did enjoy, and I guess I'll catch you in the next one. Peace out.